Savita Subramanian. She's the head of equity and quantitative strategy at Bank of America, Merrill Lynch. And Savita, great to have you with us through the next 2 hours, joining Adam and me. What do you make of this comeback we've seen in the afternoon session here in equities?
You know, I mean, I think it's a little bit of a relief rally. And I have to say, we actually got pretty constructive on the market this morning. We came out with a modest increase to our price target for the S&P 500 for this year. So we think that the year finishes...
So you increased it from 1,400?
From 1,400 to 1,450.
Okay.
You know, nothing huge, but I think that what we're seeing is on the margin, some of the sentiment indicators that we're looking at, investors are getting more bearish, which is generally a good sign for equities. In fact, one of the metrics that we look at is just the average equity allocation of my counterparts to equities in a balanced fund. And the average equity allocation has actually dropped to 54%, where the benchmark is more like 65%.
Okay.
So strategists
there's
are really...
a lot of under-investing going on.
Exactly. I think that positioning and sentiment has actually gotten quite bearish, which actually supports equities in our view.
And is that in part why right now we were just showing a chart of your three targets over really the past 7-8 months? And is it that under-allocation that in part causes you to want to up the target?
I think it's a couple of things. One is valuation, which everybody knows about the market is very, very cheap. I think that matters for the long term, and it's gotten a little bit cheaper, and I think that presents a good buying opportunity. You know, the second reason is earnings revisions trends, and one of the things that we've seen there is that analysts are actually starting to revise down less than they were a few months ago, and this is generally, again, another good sign for equities. I mean, I'm a quant, so I look at a lot of these different metrics and try to make sense of it. And I would say that over the last month, on the margin, our models have gotten more positive rather than more negative. I mean, and you know, the other aspect is when I talk about increasing our price target, everybody looks at me like I'm crazy, and I think that's actually a good sign because it shows that sentiment
contrarian play.
Exactly, to be a bit contrarian. All right, Savita, hang on. I want to bring in Alix from the New York Stock Exchange, who's been talking to traders all day about this comeback we've seen in the stock markets. Alix?
Yeah, it's a pretty dramatic reversal, as Adam was just highlighting, with the S&P up almost 30 points from where the futures hit that low of 1342. Now, in digesting this rally, it's a little bit of a mix of risk and safety. On the one hand, you have financials moving higher, but also healthcare and telecom doing well. Financials getting a big boost from Warren Buffett when you spoke to him, Betty, in Omaha, when he says that U.S. banks are in fine shape and they had liquidity coming out of their ears. Now, traders watching financials very closely as a proxy for the health of the market. Carter Worth, actually technical analyst at Oppenheimer, looking to see if some trend lines would hold as a vote for increasing risk appetite. Now, in terms of the healthcare sector, this sector helped by Boston Scientific. Its pacemaker won U.S. approval to treat abnormally slow heartbeats. That's clearing the way of sales for these devices that have been in the works for about a decade. And wrapping it up with telecom here, Sprint boosting this sector. CEO Dan Hess is actually going to return about $3.25 million of his compensation. Now, Sprint sells the iPhone at a loss, and the loss was excluded from bonus calculations, and shareholders pushed back, and it seems like they got their way. And rounding it out here with Apple, talking about financials in terms of what traders are really watching, it's Apple as a health, the proxy of the market, and that also reversing earlier losses and trading now in the green. With that, Adam, I'll hit it right back to you.
All right, that sounds good, Alix. Time for a little insight and action. And with all that uncertainty in Europe, we don't really know what's going to happen. You know what? We decided we'd bring it right back here to the good old USA. What we're doing, searching for stocks that are completely U.S. focused, 100% of their sales here in the U.S. And look at this, sales up for the most recent quarter, 25%. Earnings up for the most recent quarter by 25%. We started with the 1,500 stocks in the S&P 500. We narrowed it down to just 42. Only 5 of them are large caps. Let me show you what those 5 are. Right here, Chipotle, sales growth this year up 28%. HCP, healthcare REIT, up 49%. Lennar, I know building houses, hard to believe, right? Yeah, but look, it's up. Pioneer Natural Resources, QEP, the water guys. The point is, these are the 5 names. They're all over the map, right? It's not just one sector. And here's the other key point. With all that uncertainty in Europe, there are plenty of companies that get 100% of their business right here in the U.S., and they're growing sales, they're growing earnings. This group, by the way, of 42 names, they're up about 17% year to date. So the proof's in the pudding. They're not cheap. You're paying a higher PE, but they're also up and they're growing. Here's some of the small and mid-cap names. Buffalo Wild Wings, Casey's General Store. They operate little stores, little convenience stores throughout the Midwest, right? Great American Story. Columbia Bank out in Washington. Lithia. They sell They sell, what are we talking about here? Cars, auto parts, etc., out on the West Coast. Steve Madden Shoes. Again, Betty, you look at these companies, there are 42 of them. I'm going to post them on Twitter. AJ Insight, of course, the handle. You guys all know it. But, Betty, there's so many companies here in the U.S. where we don't even have to worry about what's happening in Europe. We can just focus right here on growing businesses, selling stuff made in America to Americans. Pretty simple stuff.
Made in America and staying in America. And, Savita, let me get your take on that. I mean, is that a good way to hedge against the European crisis?
You know, I think that it makes a lot of sense to stick with domestically exposed stocks. One thing we noticed is that the investor interest has actually been in the most foreign exposed stocks for almost the last decade, because these are the stocks that have had the highest growth potential. So at this point,
You're talking about the multinationals?
The big multinationals, the tech stocks, you know, companies that have a China play. Those have been the popular stocks to own for the last, almost a decade now, and that theme has worked really well. So today, I actually think that purely domestically focused stocks is kind of a contrarian theme in a way, because nobody's really been hunting in that ground recently.
Okay, so possibly it could work. But I want to stay in Europe for one more moment, because it is the day after in Europe, a day after voters decisively rejected the austerity-based policies of the leading governments. What isn't clear is what will replace those policies. And we're asking our economics editor, Mike McKee, for the real deal on what is next here, Mike.
Trouble. Yeah, things are already falling apart. You know, the Greek election yesterday, the results couldn't have been worse. You got 7 parties going into parliament, including the communists and the Nazis. There's no clear path to a coalition. The 2 most pro-Europe parties have only 149 seats. That's 1 fewer than a majority. The anti-bailout parties, fractious and fighting. So far, they've been unable to form a government. Antonis Samaras, the leader of New Democracy, which finished first in the voting, was given this morning 3 days to form a government. He's already given up. Now it goes to Alexis Tsipras, head of the far-left Syriza party. They finished second. They want out of Europe. He probably doesn't have a very good opportunity to form a government either, which will send it to the third party, PASIC. They don't have a great chance. Even if a government were cobbled together, it's hard to see how any legislation implementing EU demands get passed. So there's a good chance we're going to see new elections in Europe. And you have that Greece leaving the euro talk coming back now. Citigroup saying it could be as much as a 75% chance that that happens. In France, meanwhile, you've got François Hollande taking office on May 15th. He's got 4 major tasks. He has to reach détente with Angela Merkel. She invited him to Berlin. If they can't paper over their differences, markets are going to stay very volatile. Now, they've got to deal with Greece and this situation because the next Greece loans are due in June. He's got a campaign for the parliamentary elections in France in June, trying to get a majority so he can do what he wants. And speaking of doing what he wants, he has to present a budget due in July, puts money where his mouth is. He's got to tell us how he's going to cut the budget deficit that's rising there while still stimulating growth as he promised. Now, of those tasks, the relationship with Merkel might be the most important to the markets, and they might be able to find common ground on Greece because Greece is such a problem child at this point that if they work together on that one, people may forget about all the other issues for the time being.
I like it. Actually, focus on something else that doesn't involve yourself, right? Take the heat off yourself.
It's Betty's fault. You and me stick together, right?
Blame it on me, of course. But it's so interesting to me that you said Citigroup says there's a 75% chance that Greece may leave the euro. And this whole exercise, if you will, over the last year and a half has been precisely so that no country would leave the eurozone.
Well, we started with the adjective unthinkable, and now it's become no problem, according to EU and German officials who were out speaking today. They were talking about, well, it's okay if they leave the euro. Probably a little bit of a game of chicken going on. We dare you not to form a government and to leave the euro. We can live without you, but you can't live without us.
And if it were to happen, Savita, I mean, how much of an impact would it have here in the United States?
You know, I think that it's really a kind of a very stock-specific and sector-specific story. So the sectors with the largest exposure to Europe are tech, industrials, and I think these sectors have already started to price in that risk pretty heavily. But industrials is a sector that I think could get hit harder because it's not as cheap as, let's say, technology stocks. I think that if you look in the tech sector, the stocks that have a high level of European exposure have fully, or maybe even more than discounted that, whereas in industrials you haven't necessarily seen valuations as impacted.
And in other words, tech trading at, call it 13.5, 14 times earnings is cheap. That's where the market is. You're getting growth in theory, and now you're getting price.
For nothing, exactly. So tech is trading in line with the market for the first time since the mid-90s, which I think is a big buying opportunity.
What about banks, though?
Yeah, so banks are discounting the European risk quite heavily. And I think the first quarter we saw saw the U.S. financials rally because that was essentially a proxy for European banks, which couldn't be shorted. So investors were shorting U.S. banks. We saw that rally in the first quarter. I don't necessarily see that continuing, not because of Europe, but because of just the regulatory overhang surrounding the financial sector. So it's not necessarily the Europe story for banks, but it's just, you know, what is the run rate ROE of a bank stock going to be post-regulation in the U.S.? I think financials have a lot of headwinds.
So very likely we've seen the peak here for the financial rally. Is
That's my
essentially
bet.
your view?
I think that financials could just kind of malinger for the rest of the year.
Okay.
So buy tech or up your tech exposure,
like
sell
tech.
banks.
Yeah, exactly. We're overweight tech, we're underweight financials, and I think that that's kind of the relative value trade that we're seeing. Everyone talks about how financials are so cheap, but they're actually trading at a lower discount to the market than they normally do. So they're trading at a 10% discount today. Normally they trade at a 20% discount.
Okay.
They don't necessarily look that cheap.
Savita, thank you.